Good morning, good afternoon, good evening, wherever you are in the world. My name is Hugh Morris. I'm a senior research partner at Zien, and it's my absolute pleasure to be able to chair the event today. Now, I can only do that due to the generosity of our sponsors, who allow us to range widely and freely across technology, economics, and finance. And we're hugely grateful for their support to Zien and the FS Club, and thus making this program of interesting and informative events available. Now, my job is to get out of the way as quickly as possible and hand over to our speaker. But just before I do that, some housekeeping notes. The slides are available to download in the chat and on the website. We'll be holding a 20-minute Q&A after Adam's presentation. So please make sure that you use the GoToWebinar chat facility to send your questions into me, and I will relay them to Adam once he has finished his session. Now, returning to the subject of sponsors, AFME are a sponsor of FS Club, and we are delighted to have their Chief Executive, Adam Farkas, here this morning, and he is going to discuss and describe to you the subject, which really is fascinating these days: use of distributed ledger technology in capital markets, a subject on which I cannot wait to hear your thoughts, Adam, and I'm delighted to hand over to you.
Thank you. Thank you, Hugh, and good morning, afternoon or evening to everyone. I'm delighted to be part of the series of events and share some thoughts with you about this topic on the basis of a report, and I put my GFMA hat on, a report which was commissioned by the Global Financial Markets Association, AFME being part of it, with the help of Boston Consulting and two prestigious law firms earlier this year. So what I will try to do is to go through the main conclusions of the report, which is a really big one, with the caveat that if you have the time and patience to look into the whole report, you will see a lot more detail on the technological choices and how these technological choices can be made in a structured way in capital markets, applications of DLT. You can also have great details on the legal considerations of how this can fit or not fit into the regulatory framework and what would need to change. And also in the full report, you would have 5 use cases with actual transactions and actual solutions supported by our members and executed by the banks, presented in great details, discussing technology, legal, and other operational applications. So I really try to encourage all of the participants to refer to the full report for a more in-depth discussion. Can I have the first slide? But let's see what we tried to do with this report, again with the help of consultants, lawyers, and member firms, technical and markets experts. So the objective of our analysis was to try to see how DLT, by way of introducing tokenized securities in capital markets, could deliver efficiencies and innovation in capital markets in general. And what we try to do is also estimate the potential that the use of DLT could result in improving the way capital markets function. Now, before we go into some of these estimates of the potential and the typical issues, I need to make one important sort of definition issue clear and how we used different terms. So what we looked at was the tokenized securities application of DLT, i.e. The digital twin, where an existing security, and I'm talking about sort of the legal terms of issuing a security, an existing security is twinned and tokenized onto a distributed ledger. the report was not focusing on sort of native issuance of security tokens where there is no existing security in the traditional term, but the security itself is issued onto DLT immediately. Now, so we will use the first definition for the purposes of this report, which is effectively that the books and records are twinned or replicated in DLT. What the report found was that there can be massive transformative efficiency gains coming from the use of DLT in capital markets, and there are four sort of estimates which are listed here on the right hand side. First of all, the estimate is that there is a potential to save about 2 billion of operational costs by the way of the reduction of post-trade reconciliation activities by the use of DLT as opposed to existing technologies. There is potentially savings of about 20 billion globally from smart contracts automating clearing and settlement in markets. There is a potential collateral pool that could be redeployed faster of nearly 20 trillion. And of course, this is not a saving, it's a tapping into a collateral pool of that magnitude, which could be redeployed much faster than today. And the other estimate we came to is that there is about 16 trillion of currently relatively illiquid assets that could be brought into the domain of capital markets for secondary market trading, thereby increasing the liquidity of the overall market and these specific instruments. So these are, of course, have to be treated with a lot of care because these are pure estimates. Now, can we go to the next slide? The major finding of the report is that DLT-based capital markets are emerging, but there are critical barriers that must be overcome, and the barriers you can see on the right-hand side. I will come back to that in the conclusion part of the discussion. But what we found was that there can be three stages identified, and we sort of try to identify them as experimentation, commercialization, and scaling. And right now, the DLT-based markets are mostly in the sort of emerging phases. So in the first phases of this life cycle, it is important to mention that the expectation is that there could be parallel processes for different assets and different segments of the market, or even geographies. This cycle doesn't need to happen all at the same time globally for all assets. So it is emerging as a sort of parallel process for different asset classes. And we identified the main barriers being the global legal framework and regulatory framework, the interoperability or the lack of interoperability of different DLT systems, the lack of sufficient liquidity, secondary market liquidity at this point, some technology constraints that are preventing scale and sort of cybersecurity risks to be addressed at this point, but they can be addressed. And the last one is the cash lag, the payment lag, which of course is under a lot of scrutiny, and whether the payment lag will require DLT-based payment instruments, or it can be hooked into the existing infrastructure of real-time payment systems. So these are the five sort of barriers that are preventing the fast acceleration of the use of DLT in capital markets. The next slide, I would like to ask to move to the next slide, is trying to the report was trying to assess which asset classes are more prone to benefit from the use of DLT. Where do we see the readiness of adoption and the opportunity higher? And what you can see on the right hand side is a sort of clustering of the different asset classes And the top right corner shows what the markets, what the banks, and what the consultants and lawyers found collectively the most promising asset classes for an earlier adoption and use and higher potential for the use of DLT in their respective markets. And what you can see here is that this opportunity and readiness is higher around in the fixed income area, especially in the area of sort of some less liquid instruments. That was an interesting finding. We had a lot of input and a lot of questions on that. So these are the instruments where we think, and the markets are thinking, that the opportunity and readiness is going to sort of drive the process faster. The next slide, what I would like to introduce is, of course, there are lots of questions about the tech considerations. What network type is the most suited for the implementation of or the use of DLT in capital markets? Regulators are discussing it. Market participants individually discussing it. Issuers are discussing it. Observers and experts are discussing it. And what we found in the report is that there is no simple answer to this question. Whether it should be a private permission, a public permission, or a public permissionless network. What we found in the considerations, and also by looking at the actual use cases and what banks actually did in doing their own due diligence and preparation for these solutions and transactions, was that the use of or the selection of the type of network should really be driven by the use case considerations. So there is no, the report did not find a sort of simple single answer to that, but it was really trying to put a structured methodology of how this needs to be assessed. And again, there are great details on this in the report. Again, the way it is done. First of all, the first question is, are we talking about a tokenized security or a DLT-based native issuance? I said that this report is focusing on tokenized securities. The second one is the analysis of the life cycle of the activities related to this use case, whether it's a primary markets or secondary trading or post-trade life cycle, which we are trying to use DLT for, and then that leads to considerations on the choice of the tech network. And on this one, we can say that the private permission networks are from a legal point of view are pretty closely compliant with the existing legal and regulatory framework. So it's if the choice is a private permission network that can be relatively easily adapted or the current framework can be adapted to this choice, whereas in the public permission or public permissionless network is really it requires some more considerations and possibly regulatory work and technological work. Again, in the specific use cases, the choice is discussed, and the use of other network types than private permission is discussed, and it's not excluded for future reference. And I can also say that when we presented this work to various regulators, including the US Fed and European and Asian regulators, this question was one of the key questions they were sort of considering and looking for input from the banks. If we could move to the next slide. I would show you what the conclusion of the report is in terms of the potential impact of DLT. Let's say how positive the impact can be for different types of activities in the life cycle of capital markets. So we looked at primary market, secondary trading, clearing and settlement, custody, and asset servicing, and we looked at workflow efficiency. So 3 dimensions: workflow efficiency, financial opportunity and value creation, and incremental risk mitigation. And we sort of try to assess every element of the life cycle, or these different activities, from these dimensions, from these aspects. And what we found, and then we sort of added up, and so where the largest potential is. And what you can see on this chart is that the highest potential positive impact is coming in clearing and settlement, custody, and asset services. So in a little bit in the post-trade area, the potential impact in primary and secondary markets is sort of medium level, certainly less than in the other 3 parts of the securities life cycle. So this is the conclusion. Again, in the full report, there are great details on this. And this leads me to the last 2 slides, which is again bringing back the. Can we move to the next one? Is the critical takeaways from the report, which effectively identifies 5 key factors that would need to be addressed or improved in order to allow DLT and to allow this potential of DLT to come into the fore and to be utilized and deployed. The first one is the harmonization of global regulatory and legal frameworks. What is needed here is the adaptations of the existing legal and regulatory structures to promote transparent, disciplined, risk-focused, and effective market infrastructure with the use of DLT. What we found and what we are finding at this point, and the banks actually individually found in the context of the transactions, is that different jurisdictions are facing different local challenges, but some of the global challenges are very similar. And the legislative framework in different jurisdictions are at very different levels of maturity and adaptability to the use of DLT. And we think that a global approach, sort of harmonized and coordinated approach, will be very, very important. While of course the differences of national legal systems or jurisdictions would need to be recognized. That's not going to go away just because DLT is coming. But certainly this potential can only be utilized or used if there is a strong global coordination in addressing these regulatory and legal challenges. The second one is of course, again, this is an obstacle which is critical in scaling up the use of DLT, is the interoperability of this technology with the existing market infrastructure, because the expectation is that it cannot be a completely separate and parallel process. It has to be interoperable in order to allow DLT potentially to grow into sufficient scale and eventually potentially taking over legacy technology solutions and infrastructure. But in order to achieve that, this interoperability will be critical. The third one is, in one word, I would call it liquidity. Without achieving, I mean, of course, in any market, without achieving sufficient liquidity, the market will not scale up, and the efficiency gains are not going to be realized. So that growth of liquidity and sort of the spread of the use of DLT will be critical. And then on the next slide, the last two points of the 5 is that we found that there is still there are still a number of technology issues related to DLT and the use of DLT itself that would need to be addressed. So that especially in the risk mitigation space, in order to, for example, to ensure that the technology platforms, the DLT networks, are compliant with regulatory requirements, cybersecurity requirements, and other scalability requirements. So there is a need within the, let's say, within the DLT technology space to further develop the solutions to address some of these risk mitigation concerns, especially. And then I mentioned the last one is the payment side, is the cash side. That to me personally is a bit of an open question. Do we really need DLT-based payment instruments, or the existing or the interoperability with the existing real-time payment systems is sufficient? And as you know, there are pilot programs, especially run by central banks, to answer this question. But certainly, one way or the other, this will be the last condition to overcome or to meet before this huge potential can be realized. So that's the conclusion of the report, and we see that there is overall there's a huge need for the industry and market participants to talk to the public sector, to the regulatory community, because a number of these would require joint efforts on both sides. And that sort of concludes my initial remarks. I hope I stayed within my time limit, and I'm of course happy to answer any questions as long as I can. And on the last slide, I gave reference to the full report, an executive summary, and also an annex to the report, which is drawing your attention to some, let's say, taxonomy proposals which we came up with in the context of this work, given the simple issue of a lot of definitions flying around especially in the regulatory space, and we try to make a pragmatic suggestion on how to sort of put the house into order with some taxonomy solutions for making it sort of a level playing field of conversations in the discussions on the way forward. So I will stop here, and we'll be happy to seek your comments or questions on any of these topics.
Adam, thank you so much. What a fantastic mine of information and food for thought. Hugely appreciate you sharing the report's summary and conclusions with us, and you've provoked tremendous interest in the audience. So let me kick off with Dan Feeney, who asked, hi Adam, what protocols have been tested for the use cases referenced? And Dan suggests Polygon, Ethereum, Solana, Cardano, et al.
I would not be able to comment on this, because of course this goes into the individual use cases and individual banks, what they actually tested in-house. What the report comes up with is, if you look at the choices, is what the eventual choice was and on what basis. But I don't know how many what protocols and technology solutions they actually tested or looked at overall.
Thank you very much. So Alistair Milne and Herbie Skeet are in the same neck of the woods on this. So let me start with Alistair. DLT innovations are risky. The Australian Stock Exchange had to write off 250 million Australian dollars as a result of their failed DLT project. What are the risks in your proposals, and how are the write-offs of $1 billion to be avoided? And if I can append Herbie's question, which is very much along the same lines, ASX's use of DLT, Herbie says, in the project to replace chess was at first a poster child on the use of DLT. It seemed it ended up being an absolute disaster. What lessons can be drawn from this project? I think those two are sort of focusing in the same area.
I don't think I was trying to give the impression that these numbers and potentials are sort of a done deal. These are really really estimates, and I think that generally in any sort of major innovation wave of technology, there must be failures. I think that there's clearly that I have not seen any major transformation led by innovation that did not have massive failures along the way. So I think what I'm presenting here is not, or I've been presenting here, is not in contradiction with those individual, let's say, events or cases where there was a pilot or there was an initiative and it failed. And I'm not trying to say that there's guaranteed success. What I am trying to say is that there is a journey which again, these use cases are demonstrating. Of course, if you look at the transactions, typically they are experimental. They were like 50 million issuance by the EIB, which is, of course, from a funding point of view, from a market for a balance sheet point of view, is not a significant amount. So it clearly is seen as an experiment. And some of these transactions became successful, but again, on an experimental basis. And I think what I agree with is that there are loads of questions and risks along the way, and that was one of the objectives of this report. And then I tried to summarize it of what are the barriers that are preventing this to be sort of a walk in the park. It is not. And the numbers I quoted are all really, I would say, the upper potential that could possibly be achieved. It's not necessarily an expected number I try to portray. I don't know if this answered the question.
Yeah, I think what people are interested in is, are there some markers that would say these are the sort of characteristics of success for a DLT project, and here are the pitfalls to avoid? Is there anything that the research indicated that would point in any particular direction, or is it just something that's still kind of a voyage of individual exploration?
I think again, a few points where I think the report is conclusive. It is, the first one is that these experiments, and I said that if you sort of slice it up to asset classes or slice it up to life cycle events, the potential impact and the potential implementation challenges are different. So, for example, in, let's say, intraday repos, the development is more advanced. In some other areas, it's not yet showing positive signs. And the other consideration, I think, which again came out of this report, is that there is no single answer for the technology choice. It has to be use case driven and see if a specific use case can lead to a specific technology solution and a specific sort of regulatory adaptation or legal adaptation in order to make it a success. And I said everything what is in this report is in, I would call it in experimental in the first stage, maximum in the second one in the repo space. So it's clear that none of this is there at this point in time already showing that that the potential is realized and it's scaled up. It has not scaled up yet, and there is no guarantee it will. But we try to define a path, and considerations along that path, what could lead to these potentials.
Thank you. Gordon Clark and Gary Glenanalty are also related questions. So Gordon says, what's your current expectation about the timescale for tokenized securities to become widely traded? And following that up with Gary's contribution, Gary says there's no timeline range suggested in your slides. What's your best guess for early adopters through to full adoption?
I think again, I don't want to avoid answering the question, but there is a reason why there is no timeline in the paper, because it's very difficult to give an estimate and say, oh, I would think that by 2030 this will be dominant, or this will be overtaking existing sort of the existing infrastructure of the existing ecosystem. So that was in a sense that was a question which came up, but we could not give any definite timeline. So I'm unfortunately, again, I don't want to avoid the question. What I think the best guidance you can take is the actual use cases and the challenges thrown up by the use cases. That gives you an indication of what is preventing that 50 million transaction to be a 2 billion transaction and actively traded. That's really the question we all need to answer.
Well, you've skillfully avoided Winston Churchill's definition of the art of politics, which is to predict with absolute certainty what the future will hold, and then to be able to explain why it didn't.
Yes.
So Mark Heath has got a great question. He says, does Adam think that DLT will be a major contributor to driving the recent passing of the electronic trade bill, where international trade can now take place digitally under English law?
I think that's another use case which is being looked at, sort of trade finance and international trade support. Of course, this report did not have that in the scope. It did not have FX or commodities in the scope. So even capital markets was not fully covered in a wider sense. My answer to that is that I am aware of a number of banks looking into details of those use cases of using DLT in facilitating international trade and trade finance in the context of trade finance. I know a number of banks specifically who are looking into this very, I would say, with investments, with significant resources. But I would not be able to comment whether they are sort of looking promising or not. But certainly that's another potential which is being looked at very closely.
John Taylor makes a great point. He says leadership is needed on the legal issues that you correctly referred to. Who's most active in this area?
I think that the globally, first of all, there are some jurisdictions, individual jurisdictions, who are extremely active. I could mention, for example, or advanced. For example, if you look at the use cases, Luxembourg is mentioned as one. Also, some of the transactions were under French law. Some were under Hong Kong law. There are different legal systems have been used for the use cases and have been experimented with. It's clearly so there are individual jurisdictions who are really looking at this and going ahead. The US authorities are also looking at this very closely. UK authorities are looking at this very closely. So that's sort of individually. The other bodies who are I would say extremely alert are the global standard setters. So there's a lot of work done by on this by the as we all know by the FSB and the Basel Committee. The Basel Committee actually already came out with standards for the prudential treatment of digital assets, and they came out with a taxonomy. So they already embarked on trying to set out some definitions from a regulatory point of view. But this is all regulatory point of view, not necessarily the underlying legal systems or securities law and related legal issues there. IOSCO is also working there. So I would say the global standard setters are looking at this very closely, especially from a risk and regulatory point of view. Individual jurisdictions who are, let's say, more proactive in facilitating innovation, they are looking at their legal systems and trying to find the way to adopt the legal systems to this. Central banks are especially active on the let's say on the payment and payment and settlement side, and then individual. But the drivers at the moment are the individual jurisdictions who have sort of taken this up very closely.
Thank you very much. Filippo Adari raises a hugely hot topic, and he asks, what's the environmental impact and energy consumption if the DLT's full potential is realized, and set that against the reduction in global carbon emission targets? Does the report look at the issue and look at solutions that move the world along the green transition?
So the answer in short is that in the context of this report, we did not look at this. And of course, we all know that the major debate about the energy consumption related to blockchain and the technology and the different sort of first layer systems, how much energy they need, whether you want proof of work or proof of stake, and the debate around that. This report did not go down to that, let's say, first layer level and discuss the environmental impact. But I agree that should be, especially on a sort of aggregated global basis, that should be an important consideration, because it's clearly we cannot claim to move to a system which eventually might result in certain like cost savings in let's say in post trade, but on the other hand, it is putting a huge burden on the environment. So again I agree with the importance of the question, and I agree that should be a consideration. This particular report did not go into that.
Thank you. Callum Graham raises a very different but equally interesting point. He says, in the existing post-trade world, the service providers and intermediaries withhold/deduct their fees as settlement passes through their central ledgers. In a DLT system, are transactions not executed directly between counterparties, requiring intermediaries to invoice for services and await payment, which is obviously a less optimal business model for them than the status quo. Do you foresee, or how do we overcome this transition?
Yes, what I would say, this is of course a very very pertinent question, because clearly, especially in the post-trade environment, if the technology is deployed and scaled up and takes a major role, this clearly will disrupt some parts of the existing value chains and service positions, that without question, and that might impact individual firms or individual types of activities very, very differently. So I mean, given that AFME is representing the major sell-side firms who are critical in this, including custodians, for example, this of course is a very sensitive issue for a firm by firm. But overall, I think the financial services industry have seen changes of technology, have seen and have survived and overcome a number of innovations in the history, which disrupted or rearranged business models and value chains, and so the answer to that, I think there is no clear path or clear visibility, but I think everybody understands that individual firms and certain sectors and services would need to be prepared for potential disruptions or changes. Now, let's not call everything disruption, just potential changes of their value propositions, and then down to the details of invoicing. Who is going to pay for this? How this is going to be economically viable.
Brilliant, thank you. Well, I think we've time for one more question, and Dan Feeney's come in with another great question. Will the wholesale adoption of CBDCs speed up the implementation and adoption of DLT trading solutions?
The answer is, I would err on saying yes. It is one of the 5 barriers I mentioned to overcome. If CBDC is adopted widely for wholesale purposes, so we are not talking about the retail wallets of 3,000 euros or 5,000 pounds or whatever. I'm talking about the wholesale use of CBDC potentially, which is nowhere near to be there, but there's a lot of talk about it. I think that would significantly contribute to giving a push to the wider adoption of DLT in the let's say in the non-cash side of the equation. It would be one of the barriers to overcome. I also mentioned that personally, there are some pilots where central banks are experimenting whether actually this is needed, or the existing infrastructure of real-time payment systems, the different RTGS systems, it would be sufficient to help the use of DLT to be more widespread. But I think if we turn the argument around, as the question was asked, if CBDC is widely adopted in wholesale payments, I think that would give a push.
Adam, thank you so very much. I hope you can tell from the volume and intelligent nature of the questions, you have really stimulated the audience and given us all a massive amount to think about. I greatly appreciate your time today. In wrapping up, I would very much once more like to thank our sponsors, including AFME, for enabling us to run these sessions. I would also very much like to thank the audience for your attendance. And I would commend to you next week's seminars webinars on living with American power, focus on Warsaw in financial centers of the world, and then the shaping of apex decision-making in government a week today. So my thanks once again to all, and I wish you all a tremendously good rest of the morning, afternoon, evening, day, wherever you are in the world. My thanks to Adam for a great session. And wishing you all a tremendously good rest of the day. Thank you.
Thank you very much.